Let me now invite Ms. Lalitha Lodaya, SVP Credit Risk at HSBC India, and Mr. Anurag Tripathi, Head Asset and Business Banking at HSBC India, to join Gaurav Jethwani, SVP SME at HSBC India, for a conversation on making working capital accessible to SMEs. Gaurav, over to you.
Thank you, Harsh, for the introduction, and welcome audience to this discussion. And welcome, I also extend welcome to the panelists, Anurag and Lalitha. Thank you for joining us. I will straight away jump into the discussion and start with a question for Anurag. Anurag, how do banks view the ITIs sector in light of the macroeconomic scenario on the industry? Please let us know your views on that.
Yeah, thanks, Gaurav, and thanks, NASSCOM, for this SME conclave where you gave us an opportunity to address your team. It's really helpful to interact with entrepreneurs who have worked in this ITIs space. So coming to your question, Gaurav, the banks are extremely positive on ITIs. I mean, look at what ITIs sector has done for the macroeconomy. It has grown by 15% in a year of pandemic, when actually our economy was in single digit growth. It grew by 15%. It added 5 lakh to its employee base, which is already at 50 lakh people, right? So 5 million people are employed there. 40% of them being women. It is actually the second highest ODI aggregator for the country at $74 billion in the last year. Everything is positive about ITIs, and I believe that it is just beginning to scratch the surface. So it's completely upward mobile sector where it is run by majorly technocrats. So the banks are extremely positive on it. And let me just flip it a bit. Do we look at ITIs only as an customer base? No, we don't actually. ITIs actually is a sector which helps banking be better. Every day we see the technological advancements that are happening. So they are not only as a positive customer base, they are also a very important partner and vendor base for the banks to be better at what they are doing. So clearly this is one sector which all the banks are looking at very positively. That's my view on it, Gaurav.
Thank you, Anurag, for these insights. I think for me, one very interesting point that you highlighted was the two-way relationship between the banking and the ITIs sector. It's a relationship of mutual help and mutual codependence, and I'm sure both the sides are equally looking forward to grow the relationships with the other side. So thank you for that. Hi, Lalitha. Welcome once again, and thank you for joining. Having looked at the risk part of a bank's business, wherein you sort of assess the risk for customers that a bank onboards and manages, what are the challenges that you've seen small and medium enterprise owners face in scaling their businesses and becoming big? And how in your opinion has COVID accentuated those challenges? Over to you, Lalitha.
Yeah, thanks, Gaurav. So I kind of break this up into 3 parts. Okay, with respect to SME businesses, which are like either they're very small and they're scaling up, or they are at a certain scale and yet they may need capital. So I kind of highlight 3 points here. First one being access to funds, be it capital, be it debt. That I think is a very big challenge for this segment. Access to debt, because most of them could be first-time borrowers, or they may have borrowed from known sources or friends, etc. From there to move to a banking channel itself is a journey. So they may not have credit history, and access to debt can become a challenge with that sort of a background. Access to capital, I think it's not like a never-ending deep pocket. Again, there also it comes with constraints, and it has its own restrictions and limitations. So that's the first challenge. The second one, while I think with ideas and demand and validation from the market, etc., there could be product, there could be great business ideas, there could be all of that would have started. But what perhaps becomes a challenge at a later stage is the management bandwidth and the talent attraction. That's a challenge, because when you start a business with the promoter fully involved and gets involved in everything, and he takes care of everything, and suddenly when it has to scale up to the next level, it becomes a challenge for him to be as involved and to get access to the kind of talent or the professional setup that setup might need, can become a challenge. At whatever stage, when they're moving from A to B or B to C, that's a challenge that most of the SME companies would face. The third one, which we have ourselves seen, is this contingency planning and enterprise risk management for smaller companies, which again kind of links up to the first point which I made on access to capital or access to funds. Something like what happened with COVID 2-3 years, where on and off lockdowns, a lot of restrictions. Suddenly, with all of that, some might have done well, some might have needed more money. So this becomes a challenge, because to kind of have that extra buffer capital to manage contingency or to manage any sort of a disruption or an enterprise risk that can come in, can become a challenge for SME companies. These are three broad challenges, be it IT, ITES, be it any SME company. These are three broad challenges that I feel come their way when they start scaling up.
Thank you, Lalitha. That was quite comprehensive. I will now move back to Anurag. Anurag, my next question to you is on the banking piece that a ITIS company needs. So, how can banks step up and help manage ITIS company its working capital requirement efficiently? That's part one. And in addition to that, they also need a bank to support in cross-border remittances, employee salary accounts, managing their liquidity. They're setting up shop overseas, opening bank accounts outside of India. How would banks help an ITIS company in that respect?
Yeah. No, this is a very important and a very pertinent question here. I believe that the attendees would love to hear about it, what a bank can do in solving their working capital gap problem. Frankly, Gaurav, when an ITIS company is setting out in its journey, actually their equity capital is enough, because it is actually a not very capital intensive industry, right? Per se, equity usually suffices, and really bank loans are not required at that stage. What is required is as you correctly mentioned, the second part of it. What can we do about the remittances? What can we do about the collections being more effective? What can we do about their forex risk being hedged? So those are the areas which the bank actually has a lot of solutions on, and those need to be more propagated, more discussed and sold out. Basically, it's not a product sales that needs to happen. It is actually the solutions, and each company would have its own set of requirements. But generally speaking, yes, liquidity solutions are important, where collections are made more efficient. Even 1 or 2 days saved on an international remittance, be it outward or inward, makes it much more efficient, right? A good hedging solution actually takes out a lot of risk from the business itself. Therefore, the promoter can concentrate on the core business itself. One can look at receivable factoring, which is a kind of new kind of a solution rather than the stereotypical drawing power based solutions that are there. You can get more bang for your good quality receivables. You can get up to 90% against that. So that solves your working capital problem. So there are a lot of options that are available that a bank can bring to the table. Then when the lending actually requirement goes up as you grow, because you cannot keep up funding it through equity, at that stage, actually, the bank has a lot of solutions around forex based financing, which gives you good arbitrage if you have imports or exports or a foreign currency leg to your operations. And other than that, also, why only look at financing? There are a lot of other things that also a bank like HSBC brings to the party. Other banks also are there, but HSBC being the largest trade bank does have some edge on certain aspects. So we believe in relationship banking, and therefore we have a beyond banking initiative that we have. We understand that a client doesn't only look for traditional banking solutions. They may need something beyond banking. They would need an accounting platform that helps them be more efficient. They will need logistic partners which will make their business more effective. So we bring most of that on one platform. We bring cloud solutions also. So we have partnered with a lot of other fintechs and other startups as well as established players to make the journey of our clients more easy. So ITIS companies can actually figure out on a lot of such initiatives that the bank brings to the fore. And it is actually a holistic relationship banking that we do rather than just transactional banking. So that makes their working capital cycle much more efficient. I hope that answers your question, Gaurav.
Yes, it does, Anurag. And I think what's clear from the points that you spoke about is that there are solutions, products, and services available that will help a ITIS company not just manage its financing or transaction requirement, but many other pain points that a bank can offer as a bouquet or as a basket of services and products. And it's important that banks step up and sort of educate, first of all, understand the pain points of ITIS company, and then educate them on the services and products available. So thank you for that, Anurag. My next question is for Lalitha once again. Lalitha, what do an ITS business owner need to keep in mind when he's approaching a bank or a financial institution to facilitate loan funding?
Sure. So irrespective of being an ITIS or any SME company, the most important aspect that we as bankers see is the promoter background and the kind of credit history that they've had as a company, as a promoter, or like a personal guarantor, or the members of the family who are part of the business. So it becomes a very crucial aspect that the credit history is something that we look for. I will come to ITIS specific aspect, which we as bankers see, which is considering that they kind of, it's a very distributed business and they may go after similar kind of counterparties. The product offerings could be very similar. So what is it that we see? We see what are the product offerings and what differentiation that they have. Is there a niche? Is there a problem that they're really solving? What are the kind of counterparties that they have? And what sort of contracts? Are they long-term? Are they short-term? What's the FX hedging policy? Because most of these companies cater to clients overseas, so they're always exposed to currency risk. And what is it that they do? Because it will be very hard for smaller companies to take those hits if those are not envisaged and don't have a strategy in place beforehand. So these are some of the aspects that we see: the quality of debtors, and the kind of margins that these businesses are bringing. So if they have combination of products and services, how is the combined margin looking, and is that sustainable? Is the volume of sales that they're talking about is sustainable? So these are some of ITIS specific things that we as bankers look at. I mentioned about the promoter background and the credit history. And the third thing that we would like to see is the collateral. The intensity of what we expect from collateral can kind of vary. If it's a very small company, then we would like to have hard collateral, the form of their own self-occupied property or a commercial space where the office is situated. And as the company grows in size and scale, etc., this can be packaged with various other things, in terms of either the quality of debtors or what sort of counterparties, the contracts. We can look at those things as they kind of scale up. But that's also a very important aspect that we see when we evaluate ITIS companies. I hope that answers.
It does, Lalitha, and thank you for the deep insights. I will now come to the final question for this session, and that's a question for both Lalitha and Anurag. And I'll let any one of you pick it up first. And this question is around technology, and in your individual opinion, how do you see technology shaping the future of banking? So, over to both of you.
So I'll take a stab at it first, Lalita. As I mentioned in the beginning also, Gaurav, that IT/ITS segment is a very critical cog in the wheel. It's a very important partner for the banking sector. And I have reason to say that. I mean, what we have seen in the last decade, even not even a decade, let's talk about half a decade, 5 years. 2016, when UPI got introduced, we had about 100,000 transactions in about 6 months' time on it. Today, we are doing about 260 million transactions in a month. So that's what technology can do, right? It makes banking scalable. And the gap that is there in the Indian financing segment for MSMEs, sky's the limit what technology can do, right? We can reach to the nooks and corners of this country, make banking a doorstep facility for anyone and everyone, and that only technology can do. Look at what blockchain is doing across the world, right? I won't be surprised if majority of trade transactions actually get processed on blockchain going forward, because it is at a click of a button that you get everything confirmed, right? All the players are on that platform, and the more participants come on it, the richer it is only going to get. Look at what UKIN is doing. It is early days for it, but there are already 5 participants who are putting in data there, 3 participants who are withdrawing data and using that data. The more participants again who come into it, the richer it will get. And I am really very, very sanguine that the technology is going to change the way banking is looking like. And I or Lalita may actually become archaic people unless we really change ourselves. So account aggregator is another thing. I mean, that's an interesting one, where Indian government itself has come out with a policy on account aggregation in, I think, September or October of last year only. And it's very clear that it's very, very sure that they want it to be agnostic. So there may be 20 banks, but there is one aggregator who will be aggregating the service. So for the customer, that interface is what they will look at. So open banking, account aggregation, ONDC, UKIN, blockchain, you just name it. So technology is going to take it by storm, and we have to basically weather that storm and ride that storm, so to say. So that's where my thought on technology changing banking.
So I'll kind of touch upon technology in banking as far as risk management goes. So what do I see? I see this entire database decision making, automated decision making is not very far. While it can be happening in certain banks, in certain pockets, and for smaller size deals, and certain segment of clients. But I think this perhaps will be the way forward, where it will be extremely data based decision making process, and we can see the lending ecosystem changing actually. So what used to be a very difficult task to understand a credit behavior, today you actually get to know that click of the button, your CRILC or your CIBIL or Experian and your bureau reports actually give out the credit history or behavior pattern of the clients. And again, considering that there's digital footprint everywhere, so the data-based decision making is going to be the way forward, and that's something that I see happening. And the second aspect that we as banks would really learn to kind of use is the AI-based portfolio monitoring and control. So this allows banks to use again a very data-driven approach for controlling and monitoring the portfolio, rather than like going after every account trying to understand each of those accounts. While I think those still are key aspects, because relationship banking is something that all banks have, but as a portfolio control at an oversight level, etc., it makes a lot of sense to have AI-based control or oversight on the portfolio, because that makes it that much more easier and more accurate. So that's again something that we're all learning, and that's going to be a huge learning process as we move forward, because that's going to be the way forward. The other thing that I would also want to touch upon is even the regulators have actually come out and said that we should have an automated early warning signal trigger-based management within the system, because with the data that we have, we need to kind of automate and see what are the red signals that we can actually pick up from the data that we have, and what is it that we need to do. So at the end of the day, we feel that risk management also, the flavor and the dynamics will change, because there's a lot of AI, there's a lot of machine that will come in, and those will be used for risk management as well. So that's my view as far as technology and banking from a risk management perspective.
Thank you, Lalitha. With this, we come to the end of this discussion. Thank you to both of you, Anurag and Lalitha, for your deep insights on the multiple points that we covered during the discussion. I would also like to thank the audience for patiently listening to this interesting conversation. I hope there's been a discussion around multiple points that you would see as a value add. And thank you once again. With this, we end this discussion.